Hello, everybody, and thanks for tuning in. I'm Victor Haghani, founder and CIO of Elm Wealth, and this is the Elm Roundup.
So as we put a bow on 2025, this is the time of year where a lot of people are taking a look at their portfolio, thinking about big financial decisions. One of the things that a lot of big banks and asset managers and folks who are managing money on behalf of clients and institutions are thinking a lot about are something that we hear capital markets assumptions. And can you talk a little bit about what a capital markets assumption piece is, what its intention, what its goals are for someone who is thinking about asset allocation, how to use something like that?
Sure. So yeah, all of the big financial institutions from Vanguard and BlackRock and PIMCO and Goldman Sachs, everybody publishes at the end of the year what they call their capital market assumptions looking forward. And the main numbers that you get there that you should be looking for is what is their expected long-term return for U.S. equities, non-U.S. equities, bonds, et cetera. And those are really the key ones, are because that's the biggest asset that we invest in on the risk side are equities, U.S. and non-U.S. equities. And when we get these assumptions, or when we get these projections, the question is, what do we do with them? Do we just look at them and if the numbers are high, we're happy because we have a higher expected return? No, I think that beyond feeling good or bad about the future, that it should also impact how much we have allocated to U.S. and non-U.S. equities in our portfolios. We should be using those together with expectations of how risky the markets are and our own personal degree of risk aversion as well. So we like to say there's no such thing as passive asset allocation. There is no asset allocation between stocks and bonds that you should just stick to in the same way as there is something called that makes sense and is called passive equity investing, where the percentage that I want to have in all the different stocks in the U.S. stock market or non-U.S. stock market, it makes sense to hold them in proportion to their market cap weights and not have to make an active decision on how much NVIDIA should I own. The active decision is how much U.S. stock should I own, how much non-U.S. stock should I own, how much should I have in bonds and low risk fixed income. And that's going to be driven by these capital market assumptions. We're going to publish ours in early January. And one of the things that's really comforting when you see these numbers is that there's real consensus among most purveyors of these numbers. Our numbers are not that different from the numbers that Merrill Lynch and Northern Trust and AQR and PIMCO put out there. So there is a lot of agreement on the long-term expected return of investing in these markets, and it should drive our asset allocation. So really important to take a look at those and to be thinking about those with your asset allocation. Again, there's just no such thing as passive asset allocation. It is the asset allocation is always an active choice, even if we want to use index funds for our individual selection of equities.
If someone is trying to arrive at an optimal equity allocation for their family's wealth, can you provide any rules of thumb or some things that someone should think about as they're trying to figure out what that looks like for their situation?
Well, that's going to depend on those three things that I was saying before: the expected return of the risky assets relative to safe assets, risk, and your risk aversion. And I think that that you got to spend time I think the best rule of thumb, if there is a rule of thumb for getting there to a sensible portfolio, is to come up with a hypothetical world where, instead of looking at what equities actually are offering relative to safe assets, imagine that their expected return is something over safe assets, like say 4 or 5%. Choose a number, just somewhat arbitrary, but just for your thought experiment and this calibration exercise. So you say, well, imagine equities are going to offer an extra 4% return, and the riskiness of equities is about normal, not too high, not too low. How much equities do you want to have in that case? And you got to spend some time thinking about that. It's going to depend on If equities go down and the value of your portfolio goes down, you're going to be able to spend less money in the future. And how much is that going to hurt versus if equities go up and you'll be able to spend more money in the future? So you have to think through all of that. And, for a lot of people, when they think about that, they come up and they say, well, 4% is a nice, healthy extra return relative to bonds. But, it's not the best thing I've ever heard of in the world. I think maybe I'd like to have 75% in equities if I were in that world. And so once you come to answer that, and I'm not saying 75 is right for anybody, or certainly not for everybody, but you come up with that number, for most people, I think it tends to be something between, 40 and 100%. And then you look at what the market is actually offering and you make your adjustments. So if the market's only offering, if we're in an environment where equities have gone up a lot and the PEs are really high and they're only offering an extra 3% relative to fixed income, then you want less than that number that you chose for 4%. If we're in a world where equities are super risky, it's like the beginning of 2020 and it feels like the world might come to an end, you probably want to reduce your exposure because the risk is so high, but you want to be ready to increase your exposure again when things normalize and, if things normalize and risk gets lower, which it did happen, in the middle and end of 2020. So I don't know if that quite counts as a rule of thumb. We talk about it a lot more in our book. And, in some ways, the big rule of thumb is called the Merton share after Bob Merton, who gave us a simple formula for that. But I think just finding some imaginary world, figuring out where you'd want to be if you were in that world, well, then you know that you want more or less equities if return is higher or if risk is lower, etc.
So, if you pick up any newspaper, that's anyone who's talking or thinking about markets, you're bound to find someone who has made the determination that the market is in a bubble, things are risky, or there's big opportunity somewhere. How do you think about if the market is risky at any given point?
Well, I think that that it's so obvious when the market is in a risky state. And I think that the best that we can do is to recognize when we're in this risky state, rather than trying to that sometimes the market's really quiet and people are saying, oh, it's about to go crazy. Well, I think it's okay to wait until it goes crazy to then say that you're in the risky market. That it's really hard to forecast when we're going to transition either from a very risky market into a low risk market, like in the global financial crisis. All of a sudden, we went from this high risk state in the beginning of 2009 to a really calm state by the end of 2009. But it was hard to know that that was going to happen. But I think that it's fine to wait until it happens and then have your portfolio respond. And you'll always know when you're in this high risk or low risk state to a large degree, just by how volatile the market is. If the market's bouncing around by 2 or 3, if the stock market's going around, bouncing up and down by 2 or 3% a day, you're in a high risk environment. When it's moving by 0.25% or 0.5% a day, you're in a low risk environment. And we all can feel what that's like, but a lot of people try to get ahead of it and like, okay, I think that even though the market's not doing anything right now, it's super risky. And they might be right, but it's really hard to predict that. It's almost as hard to predict changes in volatility as it is to predict the direction of the market on a short-term basis. So yeah, I think it's just good to try to focus on where we are, and that's usually pretty obvious,